Well, hello everyone. Welcome to Trading Index Options. My name is Barbara Armstrong. I'm a senior manager and a coach with Charles Schwab, and I am delighted to be filling in for Mr. Ben Watson today. Looks like Ben and I have been doing a little bit of trading because he covered for my Trading a Smaller Account class on Friday. If you missed it, he did a fantastic job. You'll want to go back and catch that one in the archives. But I have the privilege of filling in for him 2 weeks in a row. So we are going to look at the trades that we did last week. We're going to place some new example trades this week, and we're going to talk about some of the nuances and differences of trading index options. So if you're new to this, you're in exactly the right place. Yeah, and it looks like the markets are crashing up today. So, what do we do with that? I always like to start by greeting those who are with us. And so I'd like to say hello to Wiley and George and Will and David and Riceberg and Sharon and John the Noble Savage, who I believe was the first one into the chat today, and Harlot and the rest of the gang. We also have Cameron May with us in the chat. He's a friend and fellow coach and knows a ton about all of the things that we're going to talk about today and investing in general. He's been doing this for a long time. So if you have any questions, don't hesitate to ask. And between Cameron and I, hopefully we can get your questions answered. Just before we get into the thick of things, know that everything that we talk about today is for general information purposes only, shouldn't be considered to be an individualized recommendation or personalized investment advice. Know that all investing involves risk, including the loss of principal. Many of us have probably felt some of the pain of that this year as the markets have pulled back, rather significantly, in the first quarter. We are going to use the Thinkorswim paper money platform on the Thinkorswim desktop. And it is a great place to learn and make sure that you understand the trading strategy you want to employ, that you have a plan in place, that you understand how the platform works before you consider trading in your own account. When you're looking at options that are at or near expiration, you've got to consider the risks, which could include lack of liquidity, price slippage, volatility, where profits can disappear quickly and losses, and they can turn into losses pretty quickly as well. Okay, so we've got to be aware of what we're doing if we're looking at a short-term trading strategy, and that is what we are going to be looking at today. We are also going to be predominantly looking at the charts, and know that technical analysis isn't recommended as your sole means of investment research. And we try and put things in context of what's going on in the market overall. There has been a significant impact to the markets this year of tariffs and uncertainty and what's going on, globally in the marketplace and all of that. So here we go. Let's get out to the platform and just have a quick review of kind of where we stand. And so I'm going to close this. But if we look at the SPX, which is our index that represents the S&P 500, we can see that year to date, we are down 8%. And that's after a fairly significant rally. At one point from the February 19th high, we were down over 21%. So, that takes us out of correction territory and into bear market territory. And we've rallied 13% off that low, but we still have, a long way to go. We still have 11.5%, that we're down off that move. And so, when we look at this, what might people see? Well, the bears might say, well, hey, we're still below. This black line is the 200-day moving average. You'd still need binoculars to see the 200-day moving average from where we are now. Point. We're still below the 30-day moving average. True. But we're above the 10-day moving average. And some people may think of that as no man's land. The other thing that the bears might point out is that because we're still below these averages, if we were to take, and just let me get rid of, why is this line here? Well, it represents a potential resistance level because it has come and hit this level not just once. It came up and hit it here. It came up and hit it again, like 3 times a lady. And now, the 30-day moving average is kind of catching up with it. But, this is a potential resistance level, and it behooves us to pay attention to that. And so some might say, hey, before I put, my bear back in the cupboard and start, embracing the bull, I want to see it move back above this line. Okay, so now what might, and one other point I want to mention on the bear side of the argument is that if we draw this line here, let me get rid of my drawing tool. And by the way, if you aren't watching Trader Talks at the Market Open, Brent Moores and Kevin Horner just had a great conversation today about what's going on in the market and, did a really detailed analysis. And I think that's a great way to start your trading day if you can tune into that. It's also archived. So, the bears might also want to point out to you that we still have a diagonal resistance line intact and it has not been broken yet. Okay. Now, I'm not trying to be Debbie Downer, but, looking at the charts is, it's a bit of an art, right? Now, what are the bulls going to be saying, as a counter to this? Well, they're going to say, okay, so we had a high here, lower high here, but it's now similar high. Not higher highs yet, but similar highs. The bulls might also be pointing out that we had a low here, and then we now have a higher low. So they could say, hey, pennant happening. And which way is it going to break? Well, we don't know yet because it hasn't broken. Yeah. So, it's trying to push, through the 30-day. Wasn't it Yoda that said there is no try, only do? So Riceberger is saying it's trying to push through the 30-day, but it hasn't quite made it yet. Okay. And so, I'm not going to spend as much time on the other charts, but, when we look at the NASDAQ, kind of a similar thing. We've got this, oh, look at this. So some might say, excusez-moi, we are breaking above this diagonal resistance line, to which I would say, to quote my old friend, well, he's not that old, but my friend Vince, who used to say, when it just crosses the line, is it a breakout or is it kind of like the bungee jump where, it ends up snapping back and turns out to be a fake out? He'd say, watch for it to cross the river and then come back and test the ice. So we've now crossed the river. We haven't really tested the ice. So this could be, like a one-day thing, or it could be the beginning of a trend reversal. And again, we have, a low and a higher low. So setting up a very, this is like an angelfish kind of pennant pattern, right? Like really wide wings, because this thing dropped like such a rock. Like, the S&P was down 21%. This was down 25.5. And even with it gapping up almost 4% up today, like that's almost like crashing up. It's still down 14% off the February low, and still down 10% year to date. Yes, and a gap can act as a support and resistance. It can, but will it? We don't know that. And then, if we come and we look at the VIX, we're still at almost 28. So here's a 1-year chart. How often have we hit 28? Once, twice, 3 times in the last year. So this is not nothing, my friends. Like, it's come a long way down from 60, but we are still like in the nosebleed section here. This is still high. Oh, that's cute. Cameron May, he's so witty. Like, he really is. He's saying angelfish pattern, will the markets flounder? Okay. God, I love that. That's okay. So, and here's the Russell. And it too, up over 3% today. And we did a trade on the Russell last week. And so I really love what Cameron has been doing in this class. What Ben has been doing in this class. And so he's been doing very high probability trades, and he has a trading plan, and you've been following it in these example trades, and you got to love a man with a plan, or a trader with a plan, shall we say. So when we look at this, the first thing is the S&P above or below the 200-day moving average? Well, we've already had that conversation. It is below, and still, pretty healthily below. And we did a trade on the SPX, and we're going to look at that one as well also. But then the second thing is, okay, given that it's below the 200-day moving average, we are now going to do a short call vertical. And we're just trading verticals, for our examples today. But a short call vertical means you're kind of sort of bearish. Okay, so we're kind of sort of bearish. And what does that mean? Well, our expectation is that this is, not likely to continue crashing up, or that we're going to place our trade so far above that we believe it is unlikely to be hit. And the idea is that we're only going to go 14 days out. And then at the 7-day mark, no matter what is going on, we're closing the trade out. Now, one of the things that I did last week, and let me just look at my calendar. So that was the 16th. 10th, 15th, 16th. So that was on this day here. So things were pulling back a little bit. So we're going to put this on here. We put on a short call vertical. Now, why did we choose these strikes in this date? Well, because May 1st, if we come out to the trade tab, May 1st was 14 days away, or the closest one to 14 days away. So now we have 8 days to go. And we also went out to the delta of 15. So we just kept scrolling. This is why I have 100 strikes here, because at a delta of 15, you are way far away. And that's how we chose the strikes that we chose. And we noticed that even at this delta of 15, and even though there wasn't a lot of volume on the Russell, we had a bid-ask spread that was less than 10%. And so we decided to go ahead, and now this is 8 days out, but we decided to go ahead and place that trade. Now, what we also did was we said, hey, like, I was going to Sonoma, I was going to wine country, and I knew that I wasn't going to be looking at the market. So I put in an exit just in case the market continued to go down and I might have the opportunity to hit my target and exit the position. So we put in an exit at an 80% of max gain. And so let's bring up our RUT. So here we are on this one. On the 16th, we did 3, and these were $10 wide. We had a $500,000 account, so we said we were okay to risk, and what were we risking? Well, this was $10 wide. We were risking about $2,500. And later that same day, we ended up hitting our target and getting out for 20 cents, which is about 80%. Now, we had put in here an exit at 30 cents. Okay, we had put in an exit at 30 cents and we got filled at 20. So this may have been a bit of a paper money fill, but the next day the market dropped and then it rallied and it dropped again. If we had just waited until today, that trade may not have been making money. And, you know, we could look at that and see 1995 and 1985 were our strikes. And it was May 1st, 1995, 1985. So if we were looking at this now, well, actually, a pretty similar price to what it is now. Okay, but you know, the net of it is because we put in an exit, you know, we were able to get out with a profit. And we didn't have to wait the 7 days. Okay. Okay. Now we also did one on the S&P 500 on the SPX. And this is where our strike was way up here. And again, when we look at this, we place this on 15th, on the 16th, which was Wednesday. We placed the trade on this day. And I think that we got out here. And you know, and then we've had a pretty big rebound. And I don't know why that yesterday, okay, oh, this is the rut, because something kind of went askew. So we put in an exit here at 34 cents. And then it says 310 credit. So I'm going to have to call the trade desk and ask how this anomaly happened. But basically, we got in for $1.80. We got $1.80 credit. And again, this could have been a bit of a paper money fill. And then we got out the next day, you know, and this triggered at 34 cents and was a limit order. So somewhere, I think this ended up being a debit of maybe 31 cents. But we were out of those trades. So, you know, if we wanted to do a wash, rinse, repeat, how might we approach that? Well, we just do the same kind of thing. So let's get rid of this drawing, and we can actually get rid of all of these drawings. So just hit clear drawing set, because we're now out of the trades that we had placed. And, you know, if you were looking to do a short call vertical, thinking that perhaps this support level might stay intact, where might you want to do it? Well, if you're thinking that this resistance level might hold, you might say, well, I'd want to be above this, above today's high, and today's high is 54.69, and above, you know, this 30-day moving average, which seems to have been acting as a ceiling as well, maybe above 5,600. Well, let's come out, because our trading plan for this is we're going to go out 14 days. So we're going to look at something that is 14 days to expiration. So May 7th. And we're going to scroll way, way down to the 15 delta. And where would our strike be? 56.90. Well, we wanted it to be at least above 5,600. And we have a, you know, about a 70-cent bid-ask spread. We've got some contracts here. And if we're looking at 56.90 and 5,700, that's paying $1.60. So what's our return on risk? So if I switch my scratch pad to a calculator, and we say, okay, I'm risking $10 minus $1.60, because that's the difference between the strikes. So $8.40. So what is $1.60 divided by $8.40? That's a 19% return potentially in a trade that we don't intend to be in for longer than 14 days. And someone's asking, why the 15 delta? Well, the 15 delta was chosen because it's a higher probability trade, but particularly when volatility is high, you know, it can still give us enough premium for from some traders' perspective to potentially be worth the risk. So with this 15 delta, and I have probability of in the money and probability of touching on my option chain. So this delta of 15, what this technically means is that if the SPX goes up by $1, the value of this option will go up by 15 cents. And what we want it to do is go down in value, the strike that we've sold, right? We're playing the time decay game, which is happening at an accelerated rate when you have only 14 days to expiration. Okay, so, but we've got a 27% chance that sometime in the, in the next 14 days that it's going to come up and at least touch it. So do we panic if it does? We do not. Yeah. So that's the thought process of the 14 days to expiration. So if I bring up the Greeks and we see theta, this is going to decline in value by $2 a day at the current price, as of today. And that is going to go up as we approach expiration. And so, this is decaying at an accelerated rate. So if we're in this for 7 days, 2 times 7 is 14. It will have lost 14 of its $18 plus a bit. And so this is really, a trade that is based on high probability where the ticking of time is in our favor. And last week it was particularly appealing because the markets were also closed on Friday. So we potentially would have had 3 days of time decay where the market was closed and yet time decay kept ticking along. Okay. Yeah, so I hope that answers that question. So we're trying to take advantage of theta here. And then if we scroll back up to the 8 days to expiration and look at the 5690 here. So, which is the same strike we were looking at. Oops, 5690. We have similar time decay here. And now our delta is 10, which is, which means we've only got, or 9. So, which means, had we bought this a week ago and we were looking at this today, and if I bring back my probability of in the money, this 5690 only has a 7% chance of being in the money at expiration. Yeah, so when you have a spread, what's good for one is bad for the other. So, you're selling the 5690, buying the 5700 to define your risk. And with these indexes, you cannot buy the index itself. You can just trade options on the index. The other thing is that these are European style options. So an option will never be assigned to you prior to expiration. Okay. Okay, so if we're looking at this, and it's kind of changing as we go here, but we're at May 7th, so 14 days to expiration. If we're willing to risk, say, $2,500, because we're risking $850 per contract, we could do 3 of these. So we're going to do 3, and then we're going to put in an exit. Again, I'm getting on a plane tomorrow to join Ben for the advanced option class in Dallas. I loved attending these as a client. I love attending them now as a coach. To just be immersed in the world of trading for 2 whole days, it really helped me accelerate my learning and link arms with a bunch of other people who were like me wanting to figure this stuff out. So here's our max credit, our max profit, $465. Our max theoretical loss, $25.35. So that's within our range of acceptability. And we're selling these verticals at 56. There are some transaction fees here. This 312, because we're looking at trading the SPX, this index, and the 390 is the 65 cent per leg per contract. So 65 cents times 6 gives us that. Okay. And then we're going to pay the same transaction fee on the way out. Okay. So if it is looping, just stay tuned. It looks like we're back. We went for a short. Okay. Okay. Yeah, and so here I'm going to take just a very short commercial break, if you will, and we're going to bring up, if you haven't subscribed to the Trader Talks channel, you'll want to do that. And when you come here to the Trader Talks from Schwab Coaching webcast channel on YouTube, the first thing that will come up is the class that's currently being taught. If you come to playlists, you'll see here, if you're just getting started, you may want to scroll down to the Getting Started series, which tend to be hunkered down here at the bottom. There is Getting Started with Stock Investing taught on Thursdays by Kevin Horner, which is fantastic. Getting Started with Technical Analysis, which is what really had my car about driving itself home. By the way, I got to drive, I'll post something on Twitter today, my first driverless car in San Francisco last weekend to Waymo. That was a pretty interesting experience. Yeah, they drive with a lot of confidence, those cars, and it was cool. So getting started with technical analysis, learning to read the charts. There's a Getting Started with Option series that Cameron May is now leading, so you may want to check that out. Yeah, and then there's Getting Started with Thinkorswim series as well. And, so there's a range that appeals to everyone. Yeah. Yeah, my daughter-in-law, was annoyed with my son for doing it, and it was there, and so we got in. But yeah, I was pretty impressed, I have to say. But watch on Twitter. I'll post something on that. The other thing that I wanted to bring up was, schwabcoaching.com, and let's just come back here. Somebody actually, I brought that up and we can come back here, but the in-person events, if you've never been one, if you've never been to one, Dallas is this weekend. It's not too late to register and join us. This is Advanced Options. And so if you have some of the basics under your belt, like you understand what it means to buy a call or sell a call, feel free to join us for that. There's no charge. We'll pay for your parking, provide breakfast and lunch. Bring your laptop because you'll be following along. It's really interactive. I think they're fantastic events. I will be at this one along with Mr. Ben Watson, who's leading the charge. Then Kevin Horner will be in Denver the first weekend in May. I'll be joining Ben in Anaheim, for another advanced option workshop at the end of May. And then we've got 2 market drives coming up in June. And Kevin will be at the one in Miami, and Ben's at all of them. But, these market drives, it starts with what is going on with the world, what is happening that is influencing the markets, so with tariffs and trade and all of that. And then it comes down to how is that impacting individual sectors? And then how might you as a trader take advantage of that by trading this particular index or stock? So it comes from here to here all in one day. And these are kind of white glove events. We have a great reception with complimentary cocktails and amazing hors d'oeuvres and stuff at the end of the day. And, again, and there's breakfast and lunch, and we cover your parking and all of it. I mean, the one in New York is right downtown at the Marriott Marquis in Times Square. The one in Miami, it's at a beautiful resort in Miami. So yeah, if you've not checked them out, you may want to do that. And if somebody has said, I'm planning on being at the one in Dallas, if you're there, please come up and introduce yourself. I'd love to meet you and get a chance to have a conversation with you in person, as opposed to these lovely one-sided conversations that we get to have, through the chat. Okay, so there's my little commercial on that. And really, it's just letting you know about resources that are available. Oh, and on the Trader Talks, like in addition to the playlist, which you guys are all really familiar with, there are now some shorts. And, as somebody who teaches getting started with technical analysis, these are really cool. Like, what is an intermediate trend? What's a long-term trend? How do you look at short-term highs in a trend or short-term lows? And they're all like under 2 minutes long. So if you've never looked at this shorts thing, you may want to check that out. I posted some of those on, on X yesterday. Okay, so let's go back to our platform, and let's come back and look at our friend, the Russell. Now, Russell, small caps, right? And similar chart to the others. And this one, we look at, this is where our strikes were when we placed the trade here last week. It'll be interesting to see where our strikes are this week. And this candle, for those of you, and in the trade management mini sessions and in the getting started playlist, I've started doing these shorts on candles, and I always think of this as an inverted hammer, but technically when it happens at the top of a list, it's called a shooting star, I think. Yeah. So I'm just checking to make sure I've got it right. Yeah, it's called a shooting star. And hey, I'm a coach. But what this sign means, this candle, this inverted pattern at a potential resistance level, is that maybe this uptrend, maybe the buyers are kind of losing some steam, and we could see a little pullback. So might this be a good day to sell a short call vertical? Because we are, below the 200-day moving average. So the choice is short call vertical. So let's come out to the trade tab. Again, how far out are we going? 14 days. So that's May 7th. We're going to come down to the 15 delta. So here we are, which means there's a 14% chance of it being in the money. And we are going to right click, and we are going to sell a vertical. Now, this is just $5 wide. So if you are, in trading a smaller account, if you are in trading a smaller account, you might not want to make this $10 wide, but, we're in a larger account. So we might say, we're okay with this amount of risk because we're willing to risk up to $2,500. So we're going to do 3 contracts. And again, we're going to put in an exit. And we're going to say, 14 and 14 is 28. Create an opposite order. And it looks like this moves in 5-cent increments. So we're going to make this 30 cents. We'd like to buy it back when it's worth 30 cents and take our risk off the table. And if we don't get out between now and, let's see if we can get $1.50 for that. Because it says $1.40 to $2. And we're going to put that in this bucket. And our strikes are at 20.50 and 20.60. So we're going to go and put that on our chart. And it's saying, note, you've selected a weekly option series with a non-standard expiration date. We know that it says weeklies right here. And then we're going to come 2050 and we're going to put this on our chart. So we're just going to take this and edit it and we're going to make it 2050, 2050. And this is now going to be May 8th. And now it's 2050, 2060. So our strikes have moved up a lot from where we were last week, which makes sense because this index has moved up a lot. So we want to see this on the right. And so how, I'm going to put my little drawing around here. What has to happen for this trade to be successful? So I'm going to get rid of that drawing. Well, what has to happen is the Russell has to stay below this line, below 2050. So if it comes up, it's at 1934. So it can come up. We've got over 100 points, worth of wiggle room. So if it comes up a little bit, we're okay, as long as it's below 2050. If it starts to go sideways, we're okay. And if it comes down, now we're really smiling. We've got a big grin because chances are the probability is higher that we'll reach our goal and get out prior to next Wednesday. Yeah. Yeah. And so now what if it goes up and it goes through? Well, now we have a trade where we could end up losing, but we have position sized so that even if we took a max loss, we have $485,000 in this account. What does 2,500 represent? Half of 1% or thereabouts. So 1% of this would be about $5,000, right? I'm rounding to 500,000. So this would be half of 1%. So is it a flesh wound? Yes. Are we happy about it? No. But if we have followed our rules, we're going to be okay. 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 So even though this isn't where we wanted it to go, there's no need to cry. And it may not end up being a max loss, just because it's a loss. It may not end up being a max loss. All right. Okay, I'm just looking at the comments. All righty. And we can go back here to our S&P 500, our SPX, and we can, and look at this one now. We've got another shooting star. And this is considered to be bearish. Now, if you look at that quick little video I created, this requires confirmation. And what is confirmation? Confirmation looks like tomorrow's candle closes below the body of today's candle. So, we could have this happen and then it could continue going up. And this is still a live candle. So, it could look different by tomorrow or by the end of the day, rather. Okay. So this trade that we just put on the SPX, this is 5690 and 5700. So we're 90 points above where last week's trade was. So 5690. So let's come here and we'll just move this line. 5690. And so here is our short call vertical. And again, I say this is kind of sort of bearish. We've got some wiggle room. It's at 5405 is where this is trading, and 5700, and it's May 8th. So as soon as you look at your chart, and how often are you going to look at this? Every day. So, tomorrow, if this pulls back tomorrow and you're up 70% of your max gain or even 50% of your max gain, you're going, hey, I got 50% of my max gain in one day. I am not going to be a greedy guts. I am going to take it. Like, this is your example trade. You can do with it whatever you want, but it would have to go above today's high, which is a potential resistance level, above the 30-day moving average, which is a resistance level, and it would have to come all the way up to this next resistance level. And as somebody said, the nights are lining up. Like, you know, I consider, so we've got 4 lines of nights protecting our position. You know, and what do I mean by that? Well, this was one resistance level, right? Today's candle was one, the 30-day moving average was one. So you could say, well, that was one, today's high is one, the 30-day moving average, that's one, this level of resistance, that's one, and then here's the fourth. You know, and yet we chose this based on what? We chose this based on delta. But what we're really just trying to do is set things up so that the probability is in our favor. And you may say, well, we're not making all that in a bag of chips. Well, you know, if you can do this week in and week out and have a degree of success, like $400 here and $400 there, it starts to look like, smell like, feel like real money. And when you think about why are you doing this? You know, you're not just doing this because you're bored and you don't know what else to do. You're doing this because you want to protect your giant heap. You want to grow your account. Maybe you want to generate income. And you know, I don't know what your account size is, and this isn't a recommendation, but if you're looking for a strategy that is, you know, higher probability, defined risk, not no risk, defined risk, you know, and higher probability, you know, and let's say your goal is to make $100 a week or $1,000 a week or, you know, $5,000 a week. I don't know what your snack bracket is, but, you know, or your account size is, but, you know, this can start, you know, this can start paying some bills if that's what you need it to do. But, you know, you've got to have a goal, have a plan, and then work your plan. You know, and then know that there are going to be times when it doesn't work out. So if you are looking to generate an income stream and you overachieve in one period of time, you may want to set that aside for when there are weeks where all hell breaks loose and it doesn't go according to plan at all. So guys, that's a wrap for today. Yes, you know, I do use the term base hit. You know, and my son-in-law has got me watching baseball now, which I thought would never happen. Yeah, so I'm now a diehard fan of the LA Dodgers. So yeah, so sue me, but it's been fun. So that's a wrap for today. Please hit the like button. It helps move this up in the algorithm so more people can find this content. Subscribe to the channel if you haven't hit the subscribe button already. It's just another free resource for you to take advantage of. Don't miss out on following Cameron and I in the land of X. We're posting content that we think you'll find valuable and informative on a daily basis. So there's another resource that is complimentary that you can take advantage of. Cameron May CS and Barb Armstrong CS. There's also a survey in the chat today. And here's the deal on the survey. If you click that link, 2 questions. 1, I hated it. 10, I loved it. And I'm going to keep coming back. And everything in between. You can also put comments in there. So I promise to not only read every comment that you choose to put in, but I will also pass those on to Ben, who is the master of this class day to day. The management team will read them also. So you do have a voice, and your voice is heard when you use that survey. So it takes you about 20 seconds. Appreciate it if you'd fill that out. Have a really great rest of your day. If you haven't had enough of me, you've got an hour break, and I forget what's up next. I'm so sorry, but I'll be talking trading price patterns at 1 o'clock Eastern. Feel free to join me for that. Take care, everyone. Bye for now.